the same time, yes, it has started recording. And at the same time, just wanted to introduce myself. I'm Chaturanga Singha. I'm currently attached to People's Leasing and Finance PLC in the managerial level. So, like Institute wanted me to share with you on a particular session on leasing and hire purchase. I'm extremely sorry that you all have to join in early morning. Slight deviation from your usual time of this particular lecture. So thank you so much everyone joining in early morning. And even though the lecture had been scheduled for 4 hours, I might not go till the entire 4 hours because if y'all are comfortable with this area, um, after going through some questions, so we should be able to get to know whether y'all have understood the particular section. So in that case, we don't have to go the entire 4 hours, but I'll make sure I won't go fast. I'll go really slowly so that all of you can understand. And it's a very interesting section in your subject, and you will be getting a good idea about what are the leases, what are the different types of leases, and what is the difference between a lease and a hire purchase. I believe you have options like you have the chat option, so that if anyone is having any question, please drop in your questions. I will answer as much as possible the way that you all can understand for every question that you have. So please feel free to ask any question, and please make it very interactive so that it will be your Sunday morning will be used in a kind of a valuable way. So what we are going to study is about leases and hire purchase. So let me make my screen full. I believe all of you can see the screen. If any of you have a difficulty, just give me an indication. And along with that, now let's get a small idea about this history. I'm pretty sure all of you have heard about the term leases. Some of you may be here who are enjoying the lease benefits as well, or some of you might be actually involved, because I'm sorry, since it's an online session, I don't get the chance of speaking to each and every one of you. In the past year, of course, I had a chance of physically meeting the students and talking to each other and getting an idea about your background. So some of you might be attached to banks or financial institutions, and maybe y'all are involved in processing leases. So you may know some of these contents that I'm going to cover today. And we have another kind of a product called hire purchase. So we are going to study about both. So in this case, let me just see, when I make the full screen, sometimes I can't see whether, but so I'll try time to time, reduce my screen and come back, because when I'm on full screen, I can't see you and I can't see whether y'all are asking any question or anything. If y'all have any disturbance, or if y'all don't get what I say clearly, or if my voice is not so clear, just let me know. Then give me an indication or drop a message in the chat box, so I'll look into adjust it and continue with the presentation. So on this aspect, we'll get to know a bit about the history of these leases. That's about earlier what happened was we are used to, in banking, we are used to obtain loans. The customers were used to obtain loans, and it could be unsecured loans, or it could be any loan with a kind of a mortgaged assets, like a property mortgage or anything. We do have property mortgage loans. We do have working capital loans that supports the business, and we do have any other different types of business loans. If you look at different banks, you have professional schemes, you have for businesses various types of schemes, personal loans, and so on. Certain loans comprised of a security or a collateral, a secured loan. Certain loans go as unsecured loans. And this has been the case, like the banking system when it started in the history. This has been the case. The customers, one major reason why the customers would come to a bank is to deposit their money, and like there may be a return for them out of that, and at the same time obtain a loan and carry out their businesses or get engaged in whatever they want. So that has been the case. Now when it came to asset secured granting, we identified like there's a kind of a special requirement, and the country came up with, Sri Lanka also came up with, in line with some other countries, the Finance Lease Act. So we are going to talk about the Finance Lease Act in the time to come, where the leasing was legalized, and Finance Lease Act came up with covering the aspects of leasing. Earlier, what we had was only the Consumer Credit Act. So it's like, Consumer Credit Act covers any granting to a customer by a bank or a finance company or a leasing company or whatever. We keep leasing companies aside for the time being, like the banks or any finance companies. Whatever the product will be generally covered by Consumer Credit Act. So that's therefore like that's the other as the default law protecting the customer and defining certain undefined terms in the agreement in terms of law. And when this leasing requirement came up, the governments those days came up with the Finance Lease Act. So their leasing was identified as a special product, and a different law with different set of terms came up, which were, I would say, more favorable to the banks or finance companies. Those days we had specialized leasing companies. There are a few at the moment as well in Sri Lanka, but most of the finance companies and even the banks have started granting lease because it covers, it's somewhat favorable in terms of the bank or the finance company, whereas when you get the Consumer Credit Act, it's more favorable on the customer's point of view, the consumer. So just I'll give you a brief on that, because we'll be looking at the comparison and the contrast. We'll be looking at the differences and similarities of these two acts in the time to come. Now, when it comes to a lease, it's like the one key element is that there has to be an agreement. Now, in a lease, we do have kind of three parties involved, but two main parties. One is the bank or the finance company that provides the particular lease facility. We call it as the lessor. So lessor, if it is a leasing company or a finance company, or if it is the bank that grants the lease, lessor will be the bank or the finance company. Whereas lessee is the one who obtains the lease facility, the customer, the ordinary person who walks into the bank and obtains the lease facility, that is the lessee. So there's an agreement between the lessor and the lessee. Now, this agreement is more powerful, but in the agreement, you can't violate, you can't have any unlawful or unethical things, but agreement is always powerful. What happens is, if this agreement is silent on a particular area, we'll be looking at the law. Now, if it comes to a finance lease, the law would be the Finance Lease Act. If it is a hire purchase, the law would be the Consumer Credit Act. So if something is not covered in the agreement, then we move to the law and get a solution there if there is a dispute between the lessor and the lessee. But having said that, the agreement when we prepare, it's usually in line with the Finance Lease Act or the Consumer Credit Act, whatever the governing law. When it comes to lease, it's the Finance Lease Act. Now, there the agreement specifies so many things like, okay, it should include like what is the amount being granted, or sometimes this comes as a schedule. Like the main agreement covers the general points, and sometimes this comes as a schedule. In most of the banks and the finance companies, it comes as a schedule where what is the facility amount that is being granted and how long, the tenor or the period, what is mentioned here, the lease form or the period, and what could be the monthly rental in that case, if it is a fixed monthly rental, or there could be like structured rental plans, variable rental plans as well. So likewise, what is the interest rate, and what is the kind of, terms and clauses, everything. How can the lease agreement be terminated? Can the lessor terminate the lease agreement and move out of it? Can the lessee terminate the lease agreement and move out of it? So what are the conditions, and what is the asset that is involved in this particular agreement? Everything will be covered there. So it's a lengthy agreement. Some of you would have seen this agreement. Like it's a very lengthy agreement. So sometimes I don't know whether the customers are actually reading all these terms and clauses, but they have to be properly reading, and they need to sign on each and every page, making sure that they understood all the clauses. So there are so many things. For an example, like I'll come now, if a lessee is asked to pay 50,000 rupees every month as the lease rental. Now, suppose a lessee is unable to make a payment, right, on a particular day. So what will happen? So the lease will be defaulted. Just like, what happens in loan. So lease is defaulted. If it is one rental, what would be the actions that you can? If it is two rentals, what would be the action? Likewise. So there are certain things. And at what point can the lease agreement be terminated? And if you terminate the lease agreement, what are the things that we can get? So I'll give you an insight as we go on. So it says the lease period is something less than the useful economic life of the asset. Now, the asset that we are using to grant the lease can be a motor vehicle, can be a machinery, can be any other asset. If you look at the Sri Lankan context, most of the leases are being granted to purchase vehicles. Like it could be a vehicle for a personal use, or it could be a vehicle for a business purpose. It could be a vehicle relevant for transport industry. So a lot of people in Sri Lankan context, they obtain leases to purchase a vehicle. But there can be certain instances that there are factories, there are production organizations that they want some other assets like machinery. You don't have enough capital to buy the machinery. You go and ask help from the bank or the finance company. One option is that they can grant a loan, keeping that machine or whatever the asset as a mortgage asset. But more than that, the finance companies and the banks, they prefer lease, because the leasing act is more powerful, and leasing provides more beneficial terms to the lessor compared to the lessee, because it's a defined law. Now, because of that, the leasing product came very popular at a particular point, and there were like the banks also entered into the leasing industry, creating a big competition within the industry. Current context of the industry, we know that there's a kind of a difficulty with the restriction of imports and all these kind of things, but still, I would say the leasing industry is surviving and managing fairly well with the existing assets and the existing vehicles and existing scenario that prevails within the country. So it says kind of less than useful economic life of the asset. Now, for an example, let's say if we buy a vehicle, let's say the vehicle has a useful life of, it could be even 10, 15 years, the Japanese vehicle or certain vehicles that today, it could be even more than that. So we see like even after 25 years, still the vehicle is being used. But let's say the fair economic life of a vehicle is 10 years. So the lease we may be granting for 4 years or 5 years, or it could be like some instances, it could be there even more than 5 years. But generally, most of the leasing companies and finance companies, they prefer to go for maximum 5 to 6 years. So that's a kind of a finance lease. So it's less than the useful economic life, because the reason is, my dear students, if the vehicle or the asset has a useful economic life of 5 years, and if you grant a lease for 6 years, so let's say something happened after 5 years, the customer is unable to pay, you don't have a useful asset because the asset's lifespan has gone. And even if you go and acquire the asset, we can't do much about it. So at the point of termination of a lease agreement, one particular right that the lessor gets is the lessor can acquire the asset back. I'm talking about the finance leases here. Operating leases, of course, it's again, I'm coming to that. finance leases, if a customer is unable to make payments according to the monthly agreement that they have, and if they default for a certain number of months, say I would say more than 3 months, rather, so it depends on the company as well, but on a general basis, I would say if the customer defaults more than 3 months, the lessor has a right. There are so many actions to be taken beforehand, but the lessor can communicate with the customer and finally terminate the lease agreement. So there's a process like we have to send a notice of termination 14 days prior to, or like nowadays with the current agreements, even it could be 7 days, certain number of days prior to termination, you need to send a notice to the customer, and then we in writing communicate a termination letter of termination, and the lessor can terminate the agreement. Once the agreement is terminated, the agreement is no longer valid. Like the lessor had moved out of the agreement. Then, now say the capital amount and the interest is not yet paid. So there's a default as well. There are some arrears as well. Now, in that case, the lessor has the right to go and acquire the asset. We call it as repossession or seizing. In general terms, you call it as seizing. The seizers help these banks and finance companies to seize the particular asset. If it is a vehicle, yes, very easy. But if it is a machinery, bit difficult. But again, you can like take necessary legitimate actions and go and acquire it if you want. So that option is available. But let's say we go and acquire, if the useful economic life of this asset is over by that time. We have granted a lease for 7 years where the useful life had been only 4 years. Now, no point of acquiring that asset, because even after acquiring it, you can't sell it and you can't try to cover up at least some part of that default, and at least to cover up the capital amount that you have granted. It won't be possible because asset is already expired. So this is something that the lessor has to be very careful. As a bank or a finance company, we have to be very careful that you need to identify what is the useful economic life of the asset, and depending on that, you grant the lease. We know that in the market, certain vehicles, I'm not a promoter of Japanese vehicles or anything, but certain vehicles, I'm taking Japanese vehicles as an example, may have a good lifespan of even more than 10 years, right? Unless some serious accident takes place or anything, it has a good economic life. So you granting a lease for 5 years, 6 years, or even 7 years, not a problem. But there may be certain vehicles who don't have that much of an useful life. Like it could be like the useful life or the economic life might be even less than 5 years. So if you are granting a lease for that type of a product, you need to be very careful, because we can enter into a lease agreement for any period. So it could be like 1 year or 2 if the useful lifespan is 5 years. If you enter into a 1 year or 2 year lease agreement, no problem. But going beyond that might be dangerous. So in this process, the owner allows unhindered right of use of asset to the user, for which the user compensates the owner by making period remittances called the lease renters. So I'm open for any questions you have. If you have anything not clear up to now, but certain things I'm explaining the upcoming slides as well. But if you have any questions, feel free to ask. Let me just stop presenting this and share an Excel sheet. I'll come back to the presentation. Okay. Now here, let me, hold on. Let me share this. Yeah. Hope all of you can see my Excel sheet. Now, in this case, hope all of you can see the Excel sheet. I'll come back to the PowerPoint. The lease facility amount, okay, could be something like this. I'm using this as an example for you to understand, right? So the lease facility amount granted, let's say, we have granted a lease facility of 3 million. Okay. Now, the customer is obtaining a lease facility of 3 million. I would say the term, the tenor or the period, the tenor or the period is kind of, let me enlarge the screen a little bit. We have entered into 48 months, right? 4 years, I would say, like 48 months, 4 years or 48 months, right? Now, what happens is every month we will have to pay. Like let's say month number. I just write a few months here, 1, 2, and so on. Every month, the customer, the lessee will have to pay. Like I just, it should go up to 48 months. I'll just show it like this: 100,000 every month you need to pay, right? So let's say that's the monthly rental is 100,000. So we go up to 48 months like this, right? This is pretty much similar to your loan amortization schedule. I'm pretty sure in banking, like you study about the loans, right? So we go up to 48 months like this. So let's assume this is a very simple lease agreement where the monthly rental is 100,000, no down payment, nothing. So it goes like this. Now the terms and conditions here is the customer will have to pay 100,000 on a particular day, on or before end of the month, or on or before a particular day of the month. Customer will have to pay 100,000 each. So we see that, okay, 100,000 multiplied by 48 months, which customer is paying back 4.8 million. 4.8 million total amount payable, right? Total amount payable is 4.8 million. But the bank granted only 3 million. Bank granted 3 million, the capital amount granted, that is the capital amount is only 3 million. So you get the difference, 4.8 million minus 3 million, 1.8 million would be the total interest or the return or the profit. Is the total profit for the company, the bank or the finance company by executing this lease agreement. Right, so I believe that simple theory is clear for you. I'll come back to this Excel as we go on, because this will be like something that will be using. So just share it. Let me just share that. Okay, so I'll stop sharing the Excel sheet and get back to the PowerPoint. Yeah. Hope all of you can see the PowerPoint again. Right. So in this process, the owner allows unhindered right of use of asset to the user. Owner is the lessor. Lessor will be the owner of the asset. Now, you might wonder how this happens. Let's say you want to buy a car, right? Or you want to buy a vehicle. Now, you don't have enough capital amount. You will go to the bank or the finance company and ask for a lease, right? So, lessor will be the bank. And car is owned by some, let's say a car sale or a private owner. Now, he is the supplier. So, you are the customer or the lessee. Lessor, we have the bank or the finance company, and the supplier of the asset. So, we have three parties here. What happens is, the lessor, the bank will pay, if the car is valuing 3 million, my example I'll take, car value is 3 million. Bank will pay 3 million to the supplier. And therefore, the absolute ownership, the real ownership of the asset will be there with the bank, right? But the bank gives me right to use the car. I'm the lessee, I'm the customer. I can use the car and I'm monthly paying 100,000 each to the bank. Right? So as long as I don't default and as long as I pay 100,000 per every month, I can enjoy the car. So it's for 4 years, a defined period. And we have a lease agreement. Me and the bank is having a lease agreement. That is the agreement between two of us. I'm the lessee and bank is the lessor. So that's how you go on. So I have an unhindered right to use of as I can use this car for my personal, what do you call, like any journey, or if it is like, if it is business already, if I'm doing a business or something, I can use it for that. So for anything I can use as long as the payment goes on, the bank will not be worried about it, right? So, for which the user compensates the owner by making periodic remittances called lease rental. So that's the lease. I believe all of you get an idea about it. So as I told you, there are two basic types of leases, the finance leases and operating leases. So what we are mostly discussing here is the finance lease, the 3-year, 4-year, 5-year, 6-year, 7-year agreements and all this kind of thing. Finance leases, but we'll identify the differences between the finance lease and the operating lease. Under finance lease, the lessor transfers to the lessee substantially all the risks and rewards. Now, for an example, in this case, let's say there's some maintenance come in my car. Right? I took this car as an example. It could be any vehicle, it could be any machinery. Yeah. For you to understand this, I take the car. Now, if that is the case, if there's any maintenance coming in, whose responsibility to do the maintenance? Does the bank come and does the maintenance? No, I have to do that. If there's a repair come, I have to do it. Then if there's some, obtaining any revenue licenses and other, the required things for you to drive the vehicle on the road, I need to take care, right? And even if there is a getting the vehicle insured, even that's my responsibility. But lessor will look at whether I'm insured or not. That they will check that. But it's my responsibility as the lessee to get all these things done. So substantially all the risks and rewards. The risk in a vehicle could be the repair and the maintenance and insurance. All these things comes to me. And the rewards also, like I can use this vehicle for any business purpose, anything that I want and make a return. Even if I hire the car and rent a car and do it, or even if you get involved in something like this Uber and all this kind of stuff and earn money, that's up to us. Bank is not worried about it as long as the payment is made every month. Incidental to the ownership of the asset. Now, if you have seen the certificate of registration, the CR book, we say, right? When a bank loan is granted, you have the mortgage ownership. But if it is a lease, you see absolute ownership. The absolute ownership is with the bank or the finance company. Whereas I will be the registered owner, the lessee, the customer will be the registered owner, but the absolute ownership is with the bank. So if there is any problem coming in, it's the absolute owner you need to confirm. For an example, let's say if there's an insurance claim, I'm taking this vehicle for you to understand this concept very easily. Insurance claim comes as per the CR, yes, absolute ownership is XYZ Bank, right? So registered owner is me. Before the insurance company releases the funds to me, they will want a no objection letter from the bank or the finance company saying that they don't have any objection because of releasing the funds to the customer. Because absolute owner is the bank, right? So that is where the real ownership lies with the bank or the finance company. Say if I have defaulted rentals to the bank might object sometimes. Bank might object and say no, like they won't say it is a default or anything, but we have an objection. Kindly remit the insurance funds to the bank. So if that is the case, insurance company will not give the money to me, but it will be given to the bank. So they will settle whatever that they want, and if there's a balance, they will see what can be done. So these kind of instances practically happen in the industry, incidental to the ownership of an asset. Rentals payable during the lease period in insufficient, it should be one word, insufficient to recover the entire capital, period insufficient to cover the required entire capital cost of the equipment and additionally provide a return. Let me correct it there. It has to be like rental payable during the lease period is, it has to be, right? Is not insufficient, is sufficient to cover the entire capital cost of the equipment and additionally provide a return on the funds invested. Now, if I go back to that Excel sheet, you will understand that, right? Because like sometimes these terminology might not be very comfortable, so I'll explain it in the most simplest form as possible, right? Now, what it says is this. Now you have this 3 million, no, 3 million is the value of the car at that point, the purchasing price. But in return, I am paying, as the lessee customer, I am paying 4.8 million. Now we have this 1.8 million, the profit to the bank. Okay, this is, I mean, from every loan or lease or whatever, the banks have to have a return, otherwise the banks can't sustain. So there's nothing wrong in that. So, because now here, with this return, this is the return what is mentioned in that PowerPoint. What it says is rentals payable during the lease period is sufficient to recover the entire capital cost. Yes, 100,000 into 48 months is sufficient to cover the entire capital cost. It covers the 3 million. It covers the 3 million. And additionally provide a return on the funds invested. So return on the funds invested is this 1.8 million. Now, really speaking, we can do a small calculation here. If any of you are attached to a bank or a finance company, you would have seen this is the rental schedule, right? So in the rental schedule, actually we can get it like, so we can just use the IRR computation. I'll just use it. Just use it here. So hold on. Like, so we can get that. I'll have this coming here. And the month, shall I put it just here, just to make sure that there's no problem. Okay. Hold on, what happened? Right. Yeah, I'll bring it here. Right. And so if we compute the IRR, don't worry, for exam purpose, you don't have to calculate the IRR. Don't worry. I'm just showing this calculation. No calculation out of this area, out of the area that I'm covering today. Yeah, exam purpose. Don't worry on that. And then put a guess, some 0.1 or something we put there. And you get, okay. Yeah, IRR. The interest rate that I have charged is 2.11%, a very small interest rate. Okay, a very small interest rate. If we just calculate the XIRR, of course, it goes with the, what do you call, it goes with the days also. You need to put the days as well. So hold on. Yeah, so just see. Yeah, 2.11%. I just put an arbitrary figure for you to understand. We don't get the loans or leases at 2.11% in Sri Lanka. But now, recently, of course, the rates have come down, but not up to 2%. But so it's a 2% return that we are talking about. And yeah, so but it's 1.8 million. That's the profit that the bank is making out of this particular lease agreement. So let me come back to the PowerPoint. Right. So rentals payable during the lease period is sufficient to recover the entire capital cost of the equipment and additionally provide a return on the funds invested. So that's the whole idea, because the banks are also doing a business now. They don't want to make losses. Actually, in Sri Lankan context, some people argue that the banks are the only institutions, or the banks and the finance companies are the only institutions that make profit. The customers are losing. So I'm not going to comment on that, but there may be some truth in that. But anyway, if the banks collapse, that's a big problem for the economy. So they need to make profits and they need to cover their expenses like the staff cost and other expenses that they get. So that is there. Right. Okay, there's somebody raising the hand. Nihal Senadira, you want to ask a question, or someone has raised the hand? If you have any question, you can either type in the chat box or you can ask the question. I can give you a chance. Or is it an accident? I believe it's an accident. So if you have any question, please feel free to stop me and ask. No problem. I won't get angry. Right? I'll just drop a chat message as soon as time to time I'll be checking the chat messages and I'll be answering the questions. So this is about it. I believe you are clear up to that point. Now, what are the risks and rewards incident to the ownership of the asset? Now, here earlier slide, we talked about risks and rewards are transferred to the lessee, that is the customer, incidental to the ownership of the asset. The legal ownership, the absolute ownership lies with the bank or the finance company. What are the risks and rewards incidental to the ownership of an asset? Some of the rewards we have mentioned here: expectation of profitable operating over the asset economic life. Now, if I just buy, now people are buying a vehicle for their personal use. Actually speaking, it's not recommended to have a lease on that, but people use leases sometimes, right? Not sometimes, it's regularly being used. What is expected here is that now, if I use them, for what purpose am I using the car? If it is for my personal use, I may not be getting a direct financial return out of it, but it may be my, I can manage my work easily, right? I can have my own transport. I don't have to depend on the public transport. I can attend to my family members' matters without any issue. Like there can be other benefits that I'm getting. But if I'm using it for hiring purpose, because some professionals even nowadays, they come to office while hiring, while giving transport. With this pandemic, of course, like maybe there are, there could be situations where you don't see that much nowadays. But earlier, like even it went up to that, but there are a lot of people who are going to office in the morning, giving transport for few others and make money out of that. Or some people are like, they are not keeping the car with them, they are hiring it out, right? Or if you are having a business or something, you can use that for business. Like if you are into the, before this pandemic and April attack and all this stuff, kind of in the tourism industry, people have their own car and they use their car to transport the tourists and they make money out of that. So expectation of profitable operating over the asset economic life. I'll take a machinery. I'm always talking about a car. The machinery is planted in a factory and within its useful life, you do a production and you make business, you sell and you make business and you make money out of it. So that is what is expected from this asset. Now, in Sri Lankan context, like the leasing industry is very much focused on the vehicles and the vehicle industry and transport. However, like in certain countries, like they are more focused on the machineries, production, businesses, and so on. That is where the lease had been used. But here we'll talk about the Sri Lankan context in a way that we can understand it better. Capital gains due to appreciation value. Now, some assets can have an appreciation. Now, we know what is happening in the current situation of the industry and how the vehicle prices have changed. Now, it happened time to time. So on certain periods, the vehicle prices come down. On certain periods, the vehicle prices can go up. Say, you granted a lease. Now, my same example, at the point of purchasing, the car price was 3 million. After 2 years, the prices have gone up and you can sell the same car at 4 million. So that 1 million extra is a capital gain. So you had the initial capital requirement only for 3 million. Now you can dispose the asset at a higher value. So there can be appreciations like that. We see some appreciations these days. If you analyze like past 50 to 20 years, it has happened time to time. The prices go up and come down, and there could be capital gains and certain points. Now the capital gain also is benefited by the customer or the lessee. Bank is worried about the 3 million that they have granted and whatever the interest that they need to get, nothing else, right? So but if there's any capital gain, if there's any additional capital value that comes in, it's for the customer. and realization of the residual value. Let's say sometimes the prices go down. You use the vehicle is not that brand new, it's old, and you can't get capital gains. Now, after 5 years or after 4 years, the car can be sold for 1 million or 1.5 million. That's called the residual value. Sunbun again Sinhala, after the useful life of an asset, at what value can you dispose the asset? So that's called the residual value or the scrap value. So let's say my car, I bought it at 3 million. Now I can sell it after 4 years for 1 million. That is the residual value. That 1 million also comes to me. Had I made the payments on time to the bank, had I covered all the lease rentals, after that, the bank is not worried about the agreement will be over. Afterwards, whatever the rewards that I'm getting will be mine. So that's the understanding of the rewards incidental to the ownership of the assets. So these are the rewards. The risks, losses arising due to idle capacity. Now let's say if it is a machinery, for an example, um, on certain periods you don't have enough demand, so you can't produce. So there's some idle capacity or your demand is very low. Machine can produce 100,000 units a month, but the demand is only for 50,000. The balance 50,000 is the idle capacity. So you may have losses. You may not get the expected revenue. Still, you have to pay the rental of monthly rental to the leasing company. Now there, it could be a loss to the business. It could be a loss to you. Obsolescence due to advancement in technology. It can happen to even in a vehicle, like idle capacity would be like if the tourism industry is at a chaos, you can't try your car had been utilized for tourist transport. Now no one is there to be transported, so idle capacity. So you have a loss, but still you have to pay the lease rental. Obsolescence due to advancement in technology. Now these assets that we are buying could be on anything, right? So here I'm talking about finance leases. So I'm not talking about operating leases where we are discussing that separately, but it could be on anything. Let's say a machinery, what we bought was of old technology. After we bought it for like 5 years, the lease is going on for 5 years. After 2 years, there's a new technology coming in. So this machine is no longer generating the required results. You can use it, but people have more advanced technology. So you are losing. Now, what are you going to do with this machinery? That's a loss for you. Can't tell, right? Even it could happen with the laptops and all these kind of things. So advancement of technology, old assets can become obsolete. Obsolete means you can't use it effectively. Variation in return to changing economic or political conditions. So we know that the country's economic conditions change time to time, political conditions can change time to time, and with that now currently we are experiencing a big issue with the foreign currency, and we have restricted import. So this is a different situation that the entire industry and the entire country is facing. Now on that, like the variations in it, you don't get the same return that you had before pandemic. So it can happen. So those are the risks that we are undertaking. So we have seen, like, people using the vehicles. Early they use for transport purpose. Now they can't use it for transport purpose. They use it for some other business. So we saw that what people underwent. That's a risk again the lessee takes. Bank or the finance company, the lessor will not be worried about that risk. So that's what we mentioned here. Lessor transfers to the lessee substantially all the risks and rewards incidental to the ownership of the asset. Because if something goes wrong, if you can't pay, the lessor can go and acquire the asset. But as long as you make the payment, all the risks and rewards are with you. You means the customer or the lessee. So I believe all of you are clear with that. So we talk about this full payout leases, a lease in which the lessor aims not only to recover initial capital outlay of the vehicle or asset through rentals, but also to earn a predetermined yield on the funds employed to finance invested. Difficult to understand technical jargons, don't worry, I'll simplify it. Full payout lease is a lease in which the lessor aims not only to recover the initial capital outlay of the vehicle or the asset through rentals, but also earn a predetermined yield on the funds employed to finance investor. Now, let me go back to my Excel sheet for you to better understand this. Right, I'll stop sharing the slides again and go back to this example. Okay, now I've got a very small example. Shall I increase this? Hold on. I'll put some dates also here. Like, yeah, I'll put the lease facility amount we are granting in November 1st, 2021. Okay, we'll format this into the date format. I'll just explain this thing with an example so that it will be easy for you to understand. And hold on, let me like make that adjustment and share the screen again. Give me a minute. Right, let me share the screen. What I did was, okay, I assume that we have granted this lease facility on 1st of November this month. Now, every month the customer has to pay. 1st of December, he has to pay 100,000. 1st of January, he has to pay another 100,000. 1st of February, 2022, another 100,000. Likewise, it goes up to 2025 since it's a 48-month arrangement. Right? Yeah. So on this, now we can compute the XIRR. Okay. Don't worry if you don't know this XIRR, right? Just simply think about something related to the interest rate and the return. If you haven't studied it anywhere, don't worry because that part will not be tested. That part will not be tested. Excel sheet gets stuck. Something happened with my Excel sheet. I'll come to that. Yeah, what I wanted to say there is like the lessor aims not only to recover the initial capital but to have a return. So that's what we saw here. That's what we saw here. On. Give me a moment. Yeah, until that is being fixed, let me share my PowerPoint. Sorry, my Excel got stuck a little bit. Until I resolve that, let me share the PowerPoint and explain that. What I was right. I'll share the PowerPoint and explain it. So sorry about it. Like something happened with my Excel. That gets resolved. Now here we had, okay, without complicating, I'll say we had the 3 million car. We bought it at 3 million and every month I had to pay 100,000. So 4.8 million for 48 months. So that 1.8 million, that's exactly what they're talking about. That 1.8 million, the additional profit to the bank is what their expectation. So the lessor's aim is not only to recover the initial capital. If they are recovering only 3 million, there's no profit for them. There's no compensation for them for time value of money. But they also earn a predetermined yield of funds. So predetermined in that case, like it could be 2%, it could be 5%, it could be 10%, whatever the yield. On that, they'll be calculating the lease rental schedule, and based on that, they'll be earning some profit. That's what the meaning of the full payout leases. Because when it comes to operating leases, you will understand the case is not like that. But in finance leases, we see it's a 4 years or 5 years, or it could be like usually a finance lease is more than 3 years. Usually the finance lease is more than 3 years, but I mean, there's no restriction. You can even go to a 1 year lease. But why finance leases are longer is that the bank wants to generate a predetermined profit. At the same time, the rental has to be affordable by the lessee as well. So you increase your tenor, the rental will be low. Let's say if you grant the lease for 3 years, it will be more than 100,000, the monthly rental. If you grant it for 5 years or 6 years, it could be less than 100,000. So according to the lessee's repayment ability, you all can adjust it. The banks can adjust it. But however, the predetermined rate, the interest rate that we quote, and that will be the yield. That will be the return. Yield means the return. The return we are getting on the funds employed to finance investor. Now, for the bank, like what they are doing is how does the bank or the finance company gets the money? I'm sure all of you know, like especially the banks, if you take, how would now for them to grant all these leases and loans, how would they get the money? Like, are we printing money at the banks? No. So as banking students, you know, I would like to see some responses in the chat box. Now, we want to grant a bank or the finance company wants to grant a lease, or it could be even a loan, right? So how would you like get the money for that as a bank? Any responses? No responses.
Depositors funds.
Sorry, Ashas, again.
Depositors fund.
Exactly. Thank you so much, Ashas. Thank you so much, Nishri, thank you so much. I just wanted to check whether you all are listening because I just see the tabs. Right. So all of you know that now the banks will be getting the depositors fund, the fixed deposit savings, and even the current accounts they operate, the depositors funds are there. Even if it's a finance company, most of the licensed finance companies are allowed to have fixed deposits and savings. So they can have that. If there is any specialized leasing company who is not registered as a finance company, I mean, most of the specialized leasing companies are also converted to finance companies now. They do have finance companies. So still they had some other sources, like they might be going to a bank and obtaining a loan or a kind of a special scheme loan at a lower rate, or maybe like they are getting the promissory notes or whatever, some other sources of funds. Now to those, you need to pay interest, right? So that's the fundamental in banks, right? For the fixed deposits and the savings accounts, you need to pay interest. So we have now, not like a production company, our top line, the revenue is the interest income that we get as from the loans and leases and whatever. And we pay for the deposit, and interest cost is our main expense. So we have the net interest income or the net interest margin is there. Now, to do that, now we have to match whenever we are like talking about granting a lease. If our funding cost is 5%, if I grant a lease at 2%, that will be a problem. If I'm granting a lease at 2%, my funding cost has to be less than that. Now that is what is mentioned here. The leasing companies in full payout leases, is where the lessor aims not only to cover the capital, but to earn a predetermined yield on the funds employed to finance investor, because they have finance money, they are getting the money from the depositors or any other sources. Banks will also have to pay an interest for them. So we need to cover that also. So our leasing rate or the loan rate will be always higher than the depositors rate because of that, because you need to cover up that gap and you need to make a profit covering all other expenses such as staff cost, fixed assets, and all these things you need to cover and pay. So that's what is expense. So when we are deciding the leasing rate, we have to be very careful, very mindful on all these aspects. So here, let me share it again. On the sale and lease back is a special term that we get. Now, in a sale and lease back, we'll get an idea what this is. Now, let's say you have a car with you. I have a car with me. My sole ownership, right? No other. Let's say it's purchased sometimes back, and I'm the absolute owner. I'm the registered owner. I need some money. It may be for working capital purpose for my business, or I need some money for some work at work related to my personal matters or something. So the banks want some assets. So what I do is I sell the asset to the bank and get a lease. So what happens is, in this case, you don't have three parties. Earlier, we had three parties. Earlier, we had the bank, the supplier, and the customer. Lessor, lessee, and the supplier was there. So lessor, the bank paid to the supplier and got the asset, absolute ownership to the bank, and gave the right to enjoy to the lessee. That's how it went. Now, in sale and leaseback, there is no supplier. I am the supplier and I am the customer. Customer and supplier is the same. The lessee is the supplier itself, because I own the vehicle. I'm having a funding requirement. I go to the bank and say, look here, I have a vehicle with me, fully owned by me. Why don't you take the ownership of this car, the vehicle, and grant me a lease? So this is called sale and lease back. So now you try to read it, you will understand. Under sale and lease back, the asset for which the user has a good title and a reasonable remaining economic useful life is sold to the leasing company. Now, in that case, this is a vehicle owned by me, and it should have a reasonable economic useful life. If it's going to get scrapped in another 2 years, the bank might say, no, we don't want your asset. Right? But if I have purchased earlier, maybe based on a bank loan or a lease or whatever, and I have fully paid it. Now it's my ownership, right? And on this, like I'm going to the bank and saying, okay, this vehicle can be used well more than another 5 years. It's in good condition. So they also check the condition of the vehicle and then they grant a lease for me. So I'm transferring the absolute ownership to the bank. That is called the sale. I'm selling the car to the bank. Bank becomes the absolute owner. And then bank grants a lease to me. Sale and lease back. Okay. So good title and remaining economic useful life. Sold to the leasing company. The leasing company leases the asset back to the user, who then becomes the lessee. So I had a vehicle. Now I became the lessee of my own vehicle because I had that funding requirement. So the absolute ownership is transferred to the leasing company or the bank. Obvious feature is the user of lessee to retain the use of the asset while disposing the ownership. Okay. Obvious feature is the user or lessee, that is me, the lessee, retaining the use of the asset while disposing the ownership. I'm selling the ownership, but I continue to use my own vehicle. Just like yesterday I had my vehicle with my ownership. Now I am still using my vehicle, but it's the absolute ownership is given to the bank. So that's about the sale and lease back feature. Now it's again a finance lease. Again, we have the lease agreement, the tenor, the facility amount, and the monthly rental, and everything is there, just like a normal lease. Only thing is that the supply payment comes to me because my funding requirement. The payment of the bank doesn't go to a third party supply, it comes to me, right? Obvious reasons for this sale and leaseback facility. One I already mentioned, to update working capital. If I'm running a business, if you are running a business, right? So you need some working capital requirement, you have some funding requirement, you have some debtors not paying on time and you need to run the business, you need some money requirement. So you have the car, take it to the bank, sell and lease back and get the money that you want. To generate book or feasible profit, where the fair market value, exceeds the depreciated value in the user car. Sometimes we do it for business strategic purpose. Now, in your accounting at the small level, you would have studied about this concept of depreciation, right? So let's assume there's no bank loan, there's no lease, you just pay money and get an asset, machinery or vehicle or whatever. You buy it. After 5 years, it's fully depreciated. After some number of years, it's fully depreciated. You had the cost and minus the accumulated depreciation, and you have the written down value. So after 4 or 5 years, the written down value of this asset becomes 0. So in your books of accounts, under property, plant and equipment, under the fixed assets, you have 3 motor vehicles, but the value is 0. Right? So there's a problem now. We have the assets, still they are in good condition. We are using them in our business, but they have a depreciated value. They have a very small value or they don't have a value at all. Right? Now, you want to recognize them, that you want to go to a revaluation. Now, when you're going for revaluation, again, some valuers come up with different values and all these kind of things. So the best way could be, again, going for a lease. So you get a funding as well. And the leased value, so whenever you get a finance lease, the finance lease will be your liability and the asset will be shown as, the vehicle will be shown as the fixed asset. Fixed asset will get a revalue, right? And you can recognize that in the books of accounts. So that's another thing, but I'm not too sure for how many businesses they do it for this purpose, but it's a strategic way of revaluing your asset as well. So that's another reason. To eliminate mismatches in financing, where original purchase of the asset was financed with short-term funds. Now, sometimes the vehicles, now since some of you might be attached to banks or finance companies, you might know about it. There are various ways that we can purchase vehicles. Like it could be a vehicle loan, or it could be just a kind of a loan given to a customer who is in good standing, but no mortgage or no absolute ownership taken of the vehicle. The purpose is that there can be situations like that, right? So in that case, sometimes, let's say, now forget about the vehicles, we'll think about something else, kind of, we want a machinery. Now we are running a business, right? I use my credit card to buy the machinery, and machinery 1 million. I have a credit card that is having a balance more than, like, available balance more than 1 million. I used it and purchased the machinery. Now I'm paying a big interest to my credit card. Problem. Now there you have a funding mismatch. The machinery generates return for over a period of 5 years or 10 years. I have used some short-term funds here. Or maybe your existing cash that you have, that you could have used for your business purpose, you have used for buying this machinery. You have outright purchase. So funding mismatch is there. In that case, a lease would be a very good option, because if the machinery or the vehicle have a useful life of 5 years, right, we can go for a finance lease of 4 years or 5 years. So the funding mismatch will be like overtaken, because you finance a long-term one and your asset is also generating returns long-term. By the returns that you generate from this asset, you can pay off to the leasing company, the lease renter. So where, like, if you had used that money, if you had used some short-term funds that you had with you, or if you had used a credit card, or if you had used any other short-term mechanism, or if you had a short-term loan, 1 year or 2 year loan you put, and you buy a vehicle. Now we have some products like where I won't mention the names of these products since like, it's not good for the companies. Now, there's a particular working capital type of loan that we see in the market. It's just for 1 year or 2 years, where you can use it for even purchasing a vehicle or a machinery, or it's ideally for working capital, but the people are using it for purchasing assets as well. What happens is like until the 2 years, it's just like a credit card. You can just go on paying the minimum interest. You need to cover the interest only. But if you get funds, you can settle the capital, and within the 2 years, you have to somehow settle the full capital and the interest. Right? So it's not a kind of a rental schedule that we see covering the capital and interest, but it's a kind of just the minimum interest that you need to pay, just like the credit card. Credit card, when you use, like you use 100,000, minimum amount you might get 10,000 monthly payment. So if you, as long as you pay the 10,000, there won't be a problem from the bank, but you are not reducing your capital amount. Now, people sometimes have used these kind of loans to purchase vehicles or assets. So we have a funding mismatch. So after some time, you realize, no, we need to get rid of this loan. Let's have a sale and lease back, or let's go for a lease of 5 years and settle that other loan or the credit card, and make sure that the long-term returns that we get from the asset will be used to pay off the leasing facility, and to reduce the finance cost by refinancing at a low interest rate. Now, we saw like a few months back, the interest rates drastically came down. Bank interest rates came down. Finance companies also, they reduced their interest rates. Even the central bank wanted like the maximum cap of rate, and all these kind of things were there. So with that, the market rates coming down, somebody might say, let's say I am enjoying a lease or a loan that I have obtained at 15% earlier, and I used it for buying this vehicle or some other purpose. Maybe for some other purpose, not related to the vehicle as well, right? So I'm having a personal loan or something where I'm paying 15%. Now the market rate is 7% or 10%. So I might say, okay, I have this car. Let's use it and get a lease at 10%, right? And then pay off that loan and reduce the finance cost. So it could be on the same asset, the vehicle. We might be having a lease or a loan, and we are trying to reduce the finance cost, or it could be any other loan. Our business is any other loan or a lease facility that we had. We want to reduce the finance cost by refinancing at a lower interest. So these are some of the valid reasons why a company, a lessee, an individual can go into a sale and lease back. Are you all clear up to that point? Any questions? Good set of students, no questions. I believe all of you can understand what I'm saying. If you all don't understand, just let me know.
Sir,
yes, Arshad.
This is regarding sale and lease back.
Yes.
What about dummy supplier? Is it mandatory for RMV purpose? Or?
Yeah, that is RMV has a requirement. It's not mandatory. It's not mandatory, but on RMV purpose, there are certain situations where the leasing companies or the finance companies, they use the dummy supplier. There could be certain special situations. So I don't want to go into too much of technical things, like where the section 12 transfers are there, and certain legal concerns are there. Then sometimes we look at this dummy supply introduction, but it's not mandatory. It's not mandatory because, like, if you look at the sale and lease back, I have seen instances where the supplier payment goes on to kind of the lessee straight away. But in some cases, yes, they do, because what happens is, now you are the registered owner, no? Right? You are the registered owner. Earlier, you were the absolute owner and the registered owner both. Now we are selling the absolute ownership to the bank, and you continue as the registered owner. So then the RMV might have a concern, okay, how can this happen? So that in those instances, we have seen dummy suppliers are being used. But it's not a mandatory thing unless specifically required by RMV for some purpose, certain vehicle categories and certain legislative requirements, they want it. But in terms of Finance Lease Act or in terms of banking, there's no requirement because it goes on. It goes on with the kind of what happens is in the CR book, you see like your name, the lessee's name appearing as the kind of the absolute owner or the owner of the vehicle, and it's transferred to the finance company or the leasing company's name, and it comes as the finance company being the absolute owner, and you become the registered owner. It's not mandatory according to my knowledge unless RMB requires it for certain requirements. People do that. But you can process that. There's no legislative problem in terms of Finance Lease Act or the central bank requirements or the banking industry as of concern or the finance lease industry as of concern. It's not required. But there are practical instances we see that it's being used. So,
thank you, sir.
Okay, thank you so much, Arsha. Any other questions that you want to cover? You can keep your questions towards the end, no problem. Like I'm still going through this. If you have anything to be clarified, even you can unmute yourself and talk or just drop a message in the text chat box. Right. So this is there. We continue. There's some disturbance. Okay, sorry about the disturbance. Some disturbance happening from my end. Right. So here, risk of financing under lease and sale and lease back. So what we thought earlier, what we looked at was the reasons, obvious reasons. What are the risks? Multiple financing. I'll take this example where I use my credit card to buy the machinery. A hypothetical example. Credit card to buy the machinery. So credit card, I'm paying a big interest. So not worthwhile. I take this machinery, but machinery is in my name. Like you don't normally buy vehicles using a credit card. That's why I don't take that example. Or let's say I had some funds, funding obtained from another party. I used it to buy the vehicle. Now I go to the bank asking for a lease to set off that credit card or set off that other liability that I have. But what I do is we get the lease, right? So the sale and lease back happens and we transfer the absolute ownership to the bank and get the money. Ideally, I should have immediately settled that credit card, but I don't do it. I'm doing a business, so I keep this money and use it for some other expenses or to do some other businesses. Now you have the credit card facility and the leasing obligation, both multiple financing. This can happen. Now, this is not possible if the vehicle is mortgaged or vehicle is given the absolute ownership. If you had a lease earlier and if you want to like release it at refinance it at a lower cost for the same asset, it's not applicable. But for a different asset, yes, right? Or like you had credit card or any other loan obtained from another party, a personal loan or a kind of a high costly, high interest bearing loan. You had the idea of settling it, but you're not doing that. Once you get that money, your plans change. That is not proper financial management, but this happens to many. Now, if you are in the banking industry, the finance industry, when we hear the stories of some customers, this is what has happened. They come up with the requirements saying that, okay, I want to settle it. That is why leasing companies or finance companies or even the bank sometimes directly make that payment to the other bank. That could be done if it is with the same asset. But if it is not related to the same asset, the other loan or the finance liability, or if it is to another asset or something like that, we can't do that. We give the money to the customer, the lessee. The lessee can do anything from that money after that. So this has happened and customers have fallen into trouble with multiple financing. Their previous loan or the credit card is also outstanding. This lease is also outstanding. Now he is unable to manage both of them. So this can happen. That's a risk. Liquidity crisis could aggravate the problem. Now, sometimes the customer didn't have that intention to like not to settle that other liability, but he is having a very difficult time. A working capital issue with the liquidity crisis, the debtors are not paying, the customers are not paying the customer. So customer might run into a liquidity problem. And because of that, because now the sale and leaseback requirement could be to compensate that working capital issue, right? But still, the problem is not fully resolved and it can continue. Ultimately, the customer will have another additional lease rental to be paid, where he is finding it difficult to manage his own working capital and run the day-to-day business operations. It can be an additional uh, burden for the customer. The funds generating under SLB could be, SLB means sale and lease back, could be used for non-income generating assets or transferring, and that could place additional burden to the business. That's also pretty much linked to the first 2 points that I explained, but I mean, if I elaborated it a bit further, I get that money. Let's say I don't have another loan obligation, but I'm having a liquidity crisis, I'm having a working capital issue. I get this money and I should have used it for more profitable business operation to run and try and recover the money that I should be getting and settle the creditors that I have and run my business smoothly. But instead of that, what I do is I go and invest that money in a different product that doesn't generate much of a return. Say, like the customer, I'm the lessee. I have 3 products, product X, Y, and Z. X is the most profitable product and the most demanded product. But what has happened is the product X has been sold to some customers on credit basis. They are unable to settle. I have a working capital issue. Now I had a vehicle, I went to the bank and got the sale and lease back. Now I'm having that money. What I should have ideally done is, if I have any raw material suppliers or somebody to do with the product X, I may have settled them, or I would have invested this money to produce more and more product X. That is the profitable one. But instead of that, my least profitable product is Z. So I thought after getting this money, I'll invest in product Z and try and sell more Z, where I'm not making profits out of it as expected. So then you already have a problem with the product X and the customers are not paying. And you have invested in a low profitable product, or maybe it's loss making product, and you have a loss there, and now you have a sale and leaseback facility also to be settled. So we are running into a chaos there. Experience show that the sale and leaseback transaction should be dealt with more care, and caution in granting. So we have to do this very, very carefully. Like when we are granting sale and leaseback, the bank or the finance company has to be very careful in analyzing the customer. I believe you all have studied somewhere about how to analyze the customers, the 3C models, 5C models, 7C models that we are having, or like at least the repayment capacity. What is the plan for the customer to settle this lease or the loan, and how it's going to be done, and what's the status of this business? All right, what is the working capital issue? What are the assets? What are the liabilities? What is the profit that they are making? All these things have to be very carefully analyzed, because when somebody comes up without a purpose, if I'm having a vehicle with my absolute ownership, I don't have to become a debtor to the bank. I don't have to sell my absolute ownership to the bank without a purpose. That purpose as a bank, we need to carefully identify. If you are into marketing or if you are into customer services, we need to very carefully identify what's the requirement. And after granting this loan, the lease, the sale and leaseback facility, can the customer pay it? Can the customer find a solution by granting this lease, right? And can the customer come out of the working capital issue or the liquidity issue that he or she is already facing? If that is not possible, best thing not to grant it. That's why we say very carefully you need to do, because with this multiple financing and all, we see in the leasing and the finance industry, especially even in the banking industry, you would have seen the customers fall into more trouble, and ultimately they are unable to settle any of the debts. And we have a problem, like then we'll have to repossess the asset. The assets may not have the fair value, and we might not be some of the debts become irrecoverable afterwards, and a lot of legal action and all these problems come. So that's where we need to be very careful in granting sale and leaseback facility. But it's a very good option for the customers. What do you mean by a true lease, right? I mean, there's certain features of the lease we are again going to revise. If a lease meets one or more of the following criteria, the risk and rewards incident to the ownership is deemed to have been substantially transferred to the lessee, is a true finance lease. Now, that we had been already talking about, in a finance lease, you transfer the risk and reward to the customer, the lessee, right? You don't keep it as the lessor. At the end of the lease term, the ownership is transferred to the lessee. Now, after 4 years, my previous example, I'll try to share the Excel sheet again, something happened. Like after 4 years, if all the payments are done, right, the bank has no interest, they'll be releasing the CR book. They'll be taking, okay, you keep your asset, the ownership is with you. Ownership is transferred to the lessee. In a finance lease, this is a feature that we see, or as per the definition of the finance lease on accounting standards, if the lease agreement contains a bargain purchase option for the lessee himself to purchase. Now, sometimes it's like now in a finance lease in Sri Lanka, mostly we see that at the end of the term, the bank will directly transfer the ownership to the customer. Right? So there's no problem from there. But sometimes, I'm talking about operating leases after this. What we see is kind of the lessee is given an option to purchase. Even in operating leases, you have that. Like if the lessee is given an option to purchase, that's a feature of a finance lease. Now, they are and most likely the lessee will exercise it, because if you are running a machinery or if you are using a vehicle, after 4 years, you don't want to sell it. If it has a useful life more, you want to keep it. So if you have in the agreement, if there's an option for the lessee to purchase in the sense like that can happen if the total capital is not recovered at that point. So let him come and purchase it, so that option is there. Then it's again a characteristic of a finance lease. But the second thing, you don't see much nowadays, because when the bank grants the lease rental schedule, they will make sure that they cover the entire capital cost, and even they have a profitable interest being collected. So if the payments are made without being defaulted at the end of the leasing term, you don't have to think about the second option. You can go with the first option, where the ownership is directly transferred to the lessee. But maybe there are certain finance companies still going on with the agreement saying that you have a purchasing option. Some operating lease agreements, we see this option is there. If that option is there, by definition, it won't become an operating lease. It becomes a finance lease on the other hand, right? So that is the problem. Now, some finance companies faced problems in granting operating leases because you have this clause, the purchasing option. If the purchasing option is there for the lessee, it is a feature of a finance lease. The lease term is substantially 75% or more of the estimated useful life of the leased asset. Usually, now if it is a 1 year or a 2 year lease where the vehicle can be used for 7 years, it can come under an operating lease, but it is not a feature of a finance lease. But sometimes we see there are leasing companies who have granted for 1 year or 2 years as well. But we say if it is a proper finance, a true lease means if the useful life is 7 years, if we grant a 5-year lease, then we are like mostly we are almost 75% there. So then okay, right? Or if it is a 5-year useful asset. Useful life is 5 years, and we grant a lease of 4 years. 80% we are covering. It becomes a true lease. Useful life is 5 years, but we grant a lease for 2 years. Can grant, but it's not a feature of a true lease or a true finance lease. From the inception of the lease, the aggregation of all present values of the future lease payments is 90% or more than the fair value of the leased asset. Let me see whether my Excel sheet is okay. I don't know what happened to it. Yeah, something happened to that. Let me give me a moment. Let me try to open up a different one. Because why I'm using this Excel sheet is that it's easy for you to understand it rather than just explaining word by word what is on the PowerPoint. But I'm really sorry, something happened to my previous Excel sheet. It's still stuck. I was trying to get the XIRR formula done. Okay, let me reopen a new sheet. Yeah, I opened a new sheet. So let me simply put without going on to XIRR thing. Yeah, share this. The previous sheet got stuck, my dear students. So sorry about it. I'll just come up with something just to explain this, just to for you to understand the concept that we are talking about. That's all. No calculation will be required for the exam purpose out of this area. I'm not too sure about the other subjects. For this particular area that I'm covering today, no calculation will be there. It's just the theory. But just for you to understand the theory, it will be very easy for you if you have this example. That's why I'm using it. Hope all of you can see this screen. So I'm taking my same example where we had to pay 100,000 for 48 months, right? 48 months. The initial amount that we have granted is 3 million. Now, what it says is this. My slide was talking about from the inception of the lease, the aggregation of all present values of the future lease payments is 90% or more than the fair value of the leased assets. Now, ideally speaking, here your granted amount is 3 million. No? Granted amount is 3 million. Have you studied about these present values and somewhere? Have we all studied this for maybe the same subject or any other subject about these present values? If you have not studied, don't worry. Let me simply explain that. Present value means now you pay the total amount payable. Total amount payable is 4.8 million. No? I'm still having the same example. 100,000 into 100,000 into 48, right? 4.8 million. Now, this 4.8 million we are paying in the future. We are paying every month for another 48 months. It will go up to 2025. We start in 2021, right? Now, that happens. What is the present value of this? Now, I showed you IRR last time we got. I'm not going for any formula calculation because I don't want to have this situation again. I'll simply say IRR is 2% for you to simply understand. That is the interest rate. Interest rate is 2%, right? Not 2%. This has to be 24% because I should have multiplied it by 12. Because Excel assumes this has to be like what we got 2% there is the monthly rate, monthly interest, not the annual rate. I forgot to multiply that by 12. So if that is the case, like you will be getting something like this, right? So let me just put it 2.11 into 12. Okay, 25%, let's assume. Let's assume 25%. 25% is the interest rate. Now, what it says is this 4.8 million that we are collecting, the present value, today's value, should be equal to 3 million or 90% of that. Now, if you are looking at a loan amortization schedule or a lease rental schedule, in this case, I'll use the lease rental schedule. Your interest rate is 25%. Let's say it's a big interest rate. I have put a big monthly rental now, right? So 25% is a large interest rate, but let's go with that assumption. Now 25% return you are expecting, and therefore you are making a profit of 1.8 million here, the bank, over a period of 4 years. Now, but if you look at if your cost of capital is 25%, if your cost of capital is 25%, when you discount these cash, right? That's like, let's say in 1 month you pay 100,000, today's value is less than 100,000. In 2 months you pay 100,000, today's value is less than 100,000. In 48 months you pay 100,000, today's value is very much less than 100,000. So the aggregation, the sum of those present values should ideally be equal to the granted amount of 3 million. That's how our leasing rental schedules are being prepared. I'm not going for this why I want to show that XIR calculation was to make sure that you understand it fully. But since the Excel sheet is giving some problem, I won't calculate it, and you won't be for this chapter. You won't have to calculate that. But the thing is, just try. Just try to understand. If you don't understand, let me know. I'll explain it again. This 100,000 into 48, you get in various months. If you try to find out today's value, we call it as the present value. Present value is the today's value. I'm explaining it so much in case if any of you haven't studied about present values yet. If you all have studied, you will understand this, right? That will be equal to 3 million technically in our leasing schedules, the lease rental schedules. What this PowerPoint is saying is it has to be 90% or more than the fair value of the leased asset. Now, the fair value of the leased asset, if we assume is 3 million, it has to be 90% or more. But of course, this is the general term that we use. But in Sri Lanka, you have these LTV ratios and things like that. Sometimes like LTV ratios, the loan to value ratio, the central bank says you can't exceed 50%. So you can't go by this definition as it is. So this is of course like with the assumption that we grant 100% lease or close to 100% lease. So don't think too much about, in Sri Lankan context about it, because sometimes our lease amount can be very much less than the real value of the vehicle because of the central bank regulations and other restrictions that we have. But why that has happened also is that the problem within the industry, because people started manipulating with the valuations and all these kind of things and tried to go for higher lease amounts, right? So your vehicle is really valuable at 3 million, but you come up with a valuation for 4 million and you try and get 3.5 million. At the end of the day, like if something happens, a problem happens, and when we acquire the asset and try to sell it, you can't get 3.5 million because that's not the real value. So that was the reason why this LTV came up, the loan to value ratios came up from the central bank. But still, according to the finance lease theory and the laws that we are looking at, if purely looking at finance lease, it says it should cover 90% of the fair value of the asset. That means technically it will be equal to 3 million or at least 90% of this 3 million. 90% into 3 million, the present value of these cash flows can need to come up. So we don't have to worry about it since we are using the kind of lease rental schedule. So it will be theoretically the present value will be equal to the facility amount that we grant. So let me stop sharing the this thing and come back to the PowerPoint. Right. So the lease term is substantially 75% or more. We talked about it from the inception. The 90% thing, just remember it, but in Sri Lankan context, there can be small mismatches due to this LTV ratio concern. The principal feature of finance lease is that the lessee has the right to use the asset while the lessor retains the legal right. We talked about it already. I don't want to repeat it. Right? The lessee has the right to use, lessor has the legal title. Separation of the user and owner in financing the purchase is essential feature finance lease. It's not only the sale and lease, but it's talking about general finance lease. User is one person, owner is another person. Right? So, and you have a third party supplier, owner is the bank or the finance company making the payment to the third party supplier. User is you and me, the lessee. So two different parties. So that's required in finance lease. These are general things that all of us know. Under finance lease, the lessee chooses the type of equipment. That is, the buyer, the customer will decide, okay, what's the type of the vehicle, what's the type of machinery. Bank doesn't go and decide it. Supplier decided by the customer, again, the finance, the lessee, like from which car sale, from which machinery supplier, decided by the lessee. Terms and warranties, you discuss with the supplier. If you are the lessee, if you are the customer, like we discuss with the supplier, right? What are the terms and warranties and all these things offered by the bank doesn't get involved. If there's a 2-year or 3-year warranty for the motor vehicle by the supplier, that's between the customer and the supplier. Bank is not worried about it. Maintenance agreement arrangements, if there is, like if the lessee will choose, like, from which service center I'm going to service the vehicle, from which company or the party that I'm going to get the machinery repair, decided by the lessee. Delivery, up to the lessee, should go and collect the vehicle or arrange, if it is a machinery, arrange the delivery, up to the lessee. Installation, this is for a machinery basically. Bank doesn't get involved, the finance company doesn't get involved, again the lessee. Most important, the purchase price of the asset. If you are feeling, okay, the vehicle is too expensive, the machinery is too expensive, you need to negotiate with the supplier and agree on the price. Then once the price is quoted, the final price, the lessor, the bank will go and make the payment to the supplier. So we as the lessee will have to decide the equipment, the supplier, terms and warranties, maintenance arrangement, delivery, installation, and even the purchase price. The bank doesn't get involved. This is the fundamental feature of the finance lease. So I'm coming to operating leases. At this point, I would like to give you a small break. But before getting a break, we can have a 10 minutes short break, because after this, we have a very short area on operating leases, and then I'll explain about the hire purchases as well. But if you all have any questions up to this point, we have covered the most important element of finance lease, and I have just briefed about is the finance lease arrangements and all. Some of you might be very familiar with this, I know. But if you have, if you are within the industry, if you are having any issues, like if you are employed at a bank or a finance company or anywhere, if you have any concerns, open for discussion. So just let me know if there is any question. If not, we'll have a short break, a 10 minutes break, I would say, and come back and continue. Any questions up to this point? No questions, I believe. So if there is any question, just keep it typed on the chat box. So once we come back, I'll answer those. We'll have a short break and get back. So now the time is 10:10 in my time. So we'll get back at 10:20. We'll restart at 10:20. Okay, shall we move forward? I have just shared my Excel sheet, which got stuck earlier. I believe all of you can see, because I got a very large monthly rental there, 100,000. We got 2% here, but that has to be actually multiplied by 12. So 25% it comes up. That will be the interest rate. Just forget about the 0.32. You just say that's a 25% interest rate scenario where we'll be getting the XIRR is something different based on the dates, the real dates. You get 28. Why that is important would be like, let's say if a consumer, the lessee defaults, right, if they don't pay on the due date, there may be a small grace period depending on the bank and the finance company. After that, if they further delay, like usually we see 7 days or 10 days or whatever the grace period. Beyond that, if they further delay, there will be penalty charges, the OD charges getting charged. Now, why we have these OD charges? Now, some customers complain that they are being penalized, but that is because when the payments are not made on time, it affects your present value. We talked about the present value, right? The present value. So present value is equal to today's value. Now, when they don't pay on time, when the lessee doesn't pay on time, what happens is, let's say you get the first payment on the due date, 100,000, that's fine. Second one, you don't get it on, let's say second one is also okay. Third one, not on February 1st, you get it on February 21st. So 20 days of delay. That will affect your present value. That will affect your return. You might not be getting this 25% or that return. So what we do is, if they delay, like when they want to make a settlement, let's say after 2 years, they want to make a settlement, right? When you are calculating the closing balance, at that point, you will have to consider any defaults, any delays that are incurred by the lessee, and try to adjust the present value and quote the final balance. So because if they don't pay it on the due date, if they delay it, there'll be like adverse effects on the present value and adverse effects on the return, the yield that we are talking about for the bank. So that will be taken into account. But on this rental schedule, basically, now here what it says is we cover if this 3 million, forgetting about the LTV problems that we have in Sri Lanka, not an LTV problem, the ruling that we have in Sri Lanka. Basically, it's like if 3 million is the real value of that vehicle, this 100,000 into 48, this rental schedule that we have calculated, the present value will be exactly equal to 3 million. That's why we get IRR 25%, because IRR is the internal rate of return of this project. If you have studied anywhere about this NPV and IRR and all those kind of things, you can recall it to there. But if you haven't studied it yet, don't worry. You won't get this calculation in this subject, this chapter. So forget about it if you don't understand this computation. So let me stop sharing, simply because I was talking about it. I just want to finish off that chapter on finance. I believe all of you are back in now. We can start with the lesson, continue with the lesson. Let me share the PowerPoint. Now we are going to look at the operating leases. Operating leases. Any lease which is not a finance lease is termed as operating. That's a simple definition you get in accounting standards, as at the same time in the any other definitions that you refer as well. Now, it's completely, most of things are opposite. Most of the features that we looked at in finance leases, opposite of that. Risk and rewards are not transferred to lessee and borne by the lessor. Typical operating lease, if it is a vehicle, good example I'm talking about here is a car. A car could be given as an operating lease by a finance institution or even a non-financial institution. Sometimes they get involved, but even in finance companies or other companies, we see the operating leases happen, right? Now, what happens is the risk and rewards are not transferred to the lessee and borne by the lessor. If a vehicle requires maintenance, repairs, or any other kind of things that they want to attain, lessor will have the responsibility. If it is the bank will have the responsibility. not like in finance lease. Finance lease, the bank was not even bothered about the asset unless there's a defaulting. Unless the lessee defaults only, then only the bank will pay the attention on the asset. Otherwise, they are not bothered about it. But here, repair, maintenance, everything borne by the, so even the revenue license for a vehicle, like borne by the lessor. So it's more problem for the lessor, but it's the nature of operating lease. Short term hire could be 1 year or maximum 2 years, not more than 3 years. Like 1 year or 2 years, short term hiring. Cost of asset not wholly recovered by the lessor. Lease period extremely shorter than the useful life of the equipment. Now, if I take you through the same example, okay, if I take you through the same example, sorry, you can't see that. No? Let me share it. Can you see the screen? I'll take the same example. I'll take just 12 months. Okay. I'll have it in another sheet. Let's assume this is an operating lease. Now you look at this. Operating lease granted for 1 year. Okay. We can start. Let me know. I'm sharing my sheet again. Can you all see it? Can you all see the screen? I believe you all can see the screen. Okay. Right. Now, here, this is an operating lease. Thank you, Goshila. Thank you for that information. Operating lease. Same story, I'm changing. Now we are granting an operating lease to the lessee. 3 million is the value of the asset, but we are granting the operating lease for 100,000 monthly rental for 12 months. This is for 12 months. Huh? Right. Short term, no? Short term for 12 months. Okay. I've taken for 13 months. Sorry. Just to be 12 months. First one is the payment out. No? The payment out is actually not applicable here because this is like supply payment is a different thing. Like the bank owns the asset and bank grants the asset for the use of leasing. Now you have 100,000 into 12 months. 100,000 into 12 months. 100,000 into 12 months is what we are getting. We are getting only 1.2 million from the lessee, which is not covering the capital amount of the value, the asset. Asset worth is 3 million. We are not covering, we are covering only 1.2 million out of the rentals. So we are not covering a significant portion or not at all the capital amount of the lease. So this is a feature of the operating lease. One option that the company has is, the lessor has is, after 1 year, they can give it as an operating lease to another party, or they can sell the asset. They can sell the asset and recover their capital. That's what they can do. So if it is on operating lease. So let me go back to the PowerPoint. Right. So the operating lease, risk and rewards are not transferred to the lessee. Short-term hire, we talked about it. Cost of the asset not wholly recovered by lessor. Lease period extremely shorter than the useful life of the equipment. Extremely shorter, right? So it's a 10-year asset. We are granting it for 1 or 2 years, right? So then other thing is cost of the asset not only covered what we looked at in that example. That's a feature of operating lease. Lessor relies on the residual value of the equipment. That's what I told you at the end of 1 year or 2 year. Lessor, the bank or whatever the company who does the operating lease has the right to sell the asset. The operating lease period will be over. Lessor will be selling the asset and recover the capital based on the whatever the scrap value or the residual value that the asset has. Right? Subsequent leases to recover the balance of net investment and to earn profit. The other option is that 1 year, this customer, the period is done, the lessee walks away, giving the vehicle to you. You can give it to another lessee and cover. So either you sell the asset or you can recover it from another lessee. Another 1 year or 2 year, you enter into an operating lease. Residual value means the value of the leased asset at the expiry of the lease term. At the end of the 1 year, what is the market value? What is the value of that asset? Is the residual value. In accounting for depreciation, you talk about the scrap value after the useful life. That is the scrap value. But here the residual value means at the end of the operating lease period. If the operating lease is for 1 year, after 1 year, what is the value of the car? That is the residual value. Value represents rental receivables for any release and the net proceeds following a sale. The value represents rental receivables for any release, okay, and the net proceeds following a sale. That is like if you want to release it again for an operating lease, or it could be on a finance lease, but here we talk about operating leases. What is the rental receivable? What is the total rental receivable? And the net proceeds of following a sale. So like, or else like, you know, after it's like if you decide to sell the asset after 1 year, what's the value that you can recover by selling it? Or if you decide to regrant another operating lease to a different customer, what's the value of the rentals that you can collect it? That is represented by the residual value. Asset user does not plan to use the asset for whole of its useful life, anticipating possible technology changes. Now, it could be like we are expecting electric cars to be more popular in another 2 years, so we want to use a petrol car only for 2 years, something like that. Or if there's a machinery, new technology machinery will come in another 1 year or 2 years. So until such time, we use the old machinery. So we are not going for the full useful life of the asset. And there could be technological changes happening. Most common type of asset used in operating lease is a car. I told you about it, and the user does not have to face the hassle of maintaining and repairing. The lessee is not bothered about any maintenance, repairs, everything is overlooked by the lessor. So that's one basic difference between the finance lease and the operating. Finance lease, maintenance, repairs, everything borne by the lessee. Lessee will have to take care. Here, all those things are borne by the lessor. Generally, operating lease is confirmed to those assets which has an established second-hand market, so that the lessor can realize the residual value. Now, if you grant it for a machinery of a particular factory, it's very dangerous, because after 1 year, are you going to uninstall that machinery and give it to another company? No, you can't do that. Like, it's very difficult. You maybe can, but it's very difficult. So when you're granting operating lease, we have to be very careful. If it's a motor vehicle like a car, where the market value doesn't drop very significantly after 1 or 2 years, it's a good option. So we have to be very careful about the asset where we grant the operating lease, because we have to be mindful about the market value at the end of the operating lease period. So that's a key concern that we need to look at. So it's not recommended that the machineries or old vehicles, or like old vehicles in the sense non-marketable vehicles, if there are, unlike motor cars and SUVs and Jeeps and all, it could be like even tractors or any other machinery type, land vehicles kind of things. After 1 or 2 years also, their value can be depreciated heavily. So you have to be very careful in granting operating leases to those. To the success in operating lease, the lessor should possess knowledge of secondary market of the types of assets leased, and also should possess technical knowledge on to minimize the cost of repair and maintenance. Now, when it comes to the Sri Lankan context, why this vehicle industry like why we are granting so much of leases for vehicles is one thing is this. The finance companies or the banks, they have some experts who have an idea about the general value, market value of an asset. You don't have to rely totally on the external valuers, right? So you also have an idea. But if it comes to a machinery or something like that, those need special expertise. So bankers or finance company staff, they won't have that knowledge most probably. So that's a problem. So in operating leases, we grant for an asset where we can have an idea or we have a reasonable idea about a second hand market value. And even to minimize the cost of repairs and maintenance, we know that even we might not be able to repair the vehicle, but we know the places where we can take them and get the repair done. That is not a problem. But if a machinery breaks down, sometimes, if it's a foreign machinery, people from that foreign country will have to come and do the repair. So that's a problem. You might grant a finance lease for the machinery because the lessee will undertake all those repair and maintenance, and you're not bothered about it. But if you are working at a bank or a finance company, if it is an operating lease, you will have to bear the repair and maintenance. It's not advisable for going for those kind of assets. So that's about the operating lease. Before I move on to hire purchases, about the finance leases and operating leases, do we have any question? Let me know. Do you all understand the difference between the finance leases and operating leases by now? Any of your companies having operating leases? Now, most of the finance companies, they are reluctant. Even the banks, they are reluctant to go for operating leases because of all these hassles. And they more focus on the finance leases because finance leases are governed by the Finance Lease Act, which gives a lot of power for the bank or the finance company. That's the reason. But operating leases are like, more favorable towards the customer and you have a lot of responsibilities. It's an operational asset to maintain operating lease assets. So I know that certain companies have completely closed down their operating leases, or like they give very low prominence on operating leases. Maybe like if they have some good set of customers, they just keep the operating leases just to please them. Like a lot of companies, they don't get involved because of the hassle, like the repairs, maintenance, and all these services that they need to provide. And after the period, you'll have to get back the asset and you have to give it for another party or you have to sell that. A lot of problems are there. So are we having any questions up to that point? If not, shall we move on? Like we are coming to the end of the lesson. Let me move on with the PowerPoint. Hope all of you can see the PowerPoint already. It's shared. Now, hire purchase has been there and is still there. It's governed by the Consumer Credit Act. Now, if we are to grant a finance lease or even an operating lease to a certain extent, yes, if we are to grant a lease, especially a finance lease, which is covered by the Finance Lease Act, we need the central bank authority. Like we know that like there are certain players who are not registered in central bank and they are doing it, but it has to be hire purchase in that case, or else you need to have a finance company within your group. It's for the banks and the finance companies and specialized leasing companies who can get involved in leases, especially finance leases. But hire purchase, in contrast, is covered by the Consumer Credit, very old Act, 1982. And there are a lot of similarities between a finance lease and a hire purchase. But one thing is that like hire purchase can be entered, it is not restricted to a finance company or a leasing company or a bank. That's what we need to understand, because we see, I won't mention any commercial names, but we know like there are certain electrical equipment suppliers. You can go for an easy payment scheme. You're entering into an agreement. You're covered by the Consumer Credit Act. It's very much similar to a hire purchase, right? And even these leasing companies and the finance companies, they had hire purchases sometimes back. Those days, there was a difference that for the lease rental, VAT was to be paid, and for hire purchase, the VAT was not there. So hire purchase was also marketed by the finance companies those days. But after, like, I believe it was after 2012 or 13, the government removed the VAT liability on the lease rentals, and with that, leases became more marketable, right? And hire purchase, getting involved in hire purchase by finance companies and leasing companies was reduced. But there are, like, microfinance companies, there are like other electrical equipment suppliers that I told you. There could be like certain other different products related to even a finance company where we still see a hire purchase agreement or agreement similar to a hire purchase where it's not covered by the Finance Lease Act. So then it comes under Consumer Credit Act. Again, it has an agreement, just like the lease agreement. The Act defines hire purchase agreements under which the possession of the goods are delivered by the owner to a person paying on a agreed amount in periodic installments. Now, it's not only about the vehicles that these people are talking about. It could be on buying and selling. Now, we have, like, if any of your companies are involved in Islamic finance, you have this murabaha and trading murabaha products are there, like kind of things, or different names can be given depending on your company. Like where it's about the goods you're buying and selling, your customer is a buying and selling, having a buying and selling organization. They get the goods. To get the goods, they need some funds. So you enter into an agreement similar to a hire purchase agreement. So the bank or the finance company will pay to the supplier of the goods and make sure that the goods are delivered to the customer. But in practical in Sri Lanka, like, the customer will go and take it. But that's how the act goes on. But it happens pretty much similar to a leasing agreement in Sri Lanka. Like when the hire purchases were used for granting facilities for vehicles as well, still just like in the lease, the customer would have gone there and got the vehicle from the supplier. So in practice, there are some differences here, but as per the act, what it says is the hirer, the owner is the, like the lessor. I won't use the term lessor here. You have the owner and the hirer, the customer, right? So owner will make sure that the goods are delivered to the customer, and the customer promises to pay an agreed amount every month or in every period. He has an option to purchase goods in accordance with the terms of agreement or acquiring the property in the goods on the payment of installment amount. Now, that is the owner, the bank or the finance company has an option to purchase the goods according to the agreement or acquiring the property in the goods on the payment of the installment amount. That's like, okay. That makes it much more similar to a finance lease. Now, we pay the supplier, the bank pays the supplier, and the customer will get the goods, and customer enjoys the benefits of the goods, and customer can sell it or do whatever, right? But the ownership, the absolute ownership of the goods will be with the bank. Again, the absolute ownership of the goods will be in terms of the bank. Now, if you have seen, nowadays we don't see it. If you have seen any vehicle where a hire purchase facility is granted, again, the absolute ownership will come to the leasing company or the finance company or the bank, just like in finance lease that we grant. But we are making a payment to the supplier. The goods are delivered to the customer. Customer is the hirer who will enjoy the benefits. Accordingly, if a lessor in finance transaction agrees to transfer the leased equipment to the lessee, then the lease transaction would in law be a hire purchase transaction. So, yeah, so the only difference here is even a lease transaction, if the lessor agrees that the equipment or the goods are transferred to the lessee. So that will be just like a hire purchase transaction in law. That's the only difference. Only difference. But I told you the Sri Lankan context, practically that is happening. Even the hire purchase sometimes is following the leasing terms. Now you think about an electrical equipment supplier. You buy a fridge from, I won't mention the companies again, like we know who are the vendors in Sri Lanka who would provide a fridge, and you can't transport in your own vehicle. So you enter into a hire purchase agreement that you can't pay the fridge the full amount now, but you pay in installment. So then the company, the owner will have a kind of an obligation to make sure that the fridge is transferred to your house, transported to your house, and you enjoy the benefit. And you, without defaulting, will pay the monthly installment to the owner of the asset, that is the finance company or whoever the person who provided the funds on behalf of the fridge, right? So that's a hire purchase agreement. Are you all okay up to that point? Anything not clear before we move on? Okay. Operating lease is not governed. Thank you, Nilushi, for the question. Operating lease is not governed by the Finance Lease Act. It says Finance Lease Act. Finance Lease Act. It's not governed by the operating lease is not governed by the Finance Lease Act, because it really says it's for the finance leases. Anything that is not covered under finance lease will usually come under Consumer Credit Act and the consumer protection laws, and all these things will be there. But the problem doesn't come, even the Consumer Credit Act is a question mark, I would say to you, because the lessee has no intention to acquire the asset at the end of the period. It's just using. It's like you enter into a lease agreement. Like, let's say, now a simple thing for you to understand is, you go for a rented house, or you go for a house on a lease basis. Monthly rental you pay for a fixed term period, 1 year or 2 years or 5 years or something. After that time, you'll have to leave the house. You're not going to own the house now. So that even the consumer credit requirement doesn't come. But if it is to be applied, yes, consumer credit can be applied, but that requirement doesn't come. We hire a vehicle for temporary basis, just for 2 months or 3 months or 1 year. After 1 year, you hand over the vehicle. You don't have an intention to own the vehicle. But if there is a clause in the agreement, in the operating lease agreement, that's why I mentioned that very clearly. The operating lease agreement, if there's a clause that at the end of the lease period, the lessee may exercise the right to purchase the vehicle, then it becomes a finance. Even if the agreement says operating lease agreement, then it comes under finance lease. Because there had been some issues. I won't mention the companies again that I know. I know a particular finance company where the operating leases were operated, but the agreement contained the customer has the right to purchase, has the right to ask for the purchase of asset at the end of the lease term. Then it comes under Finance Lease Act, even though your heading of the agreement will say operating lease. Then it's covered by Finance Lease Act. If not, everything is covered by the Consumer Credit Act. Okay. Thank you so much for asking that question. We'll move on. Consumer Credit Act may be better understood with the following terms. Owner means the hire purchase company, the bank, or it doesn't have to be a bank or a finance company. It can be electrical supplying company, even can be the hire purchase company. Hirer is the client. Cash price is the price at which asset is purchased. If you are paying cash, if you are buying a fridge, 75,000 is the cash price. But if you are going on a hire purchase agreement purpose, you have to pay more than 75,000. So that is there. Deposit, some payable by the hirer by way of initial payment or a deposit. Usually in hire purchase, you can ask for a down payment or an initial payment. Sometimes they don't. But usually you ask for a down payment, at least 1 month's rental or something more than that. That is the deposit. Net cash price is cash price less deposit. If you have a down payment, even in finance leases, we see that sometimes. Your real finance amount is after deducting the down payment. Let's say your cash price is 75,000. They ask for a 25,000 down payment. So net cash price is 75,000 minus 25,000, 50,000. And that 50,000 you can pay in, let's say, 12 months in monthly installments or 15 monthly installments or whatever. So you can pay that. That is where we enter into a hire purchase agreement. Hire purchase price is the sum payable by hirer to obtain an ownership as per the agreement. Let me get you an example there as well. I hope my Excel sheet doesn't get stuck. Let me stop sharing this. And let me try to share this. Okay, I'll take a different example. Now, cash price, let's say, is 100,000, right? You think about a fridge, 100,000. Okay, and down payment, you have a down payment, that is what I referred in that particular thing as deposit. Deposit is 10,000. They ask for 10,000, right? So then net cash price is 100,000 minus 10,000, that will be 90,000. 90,000 is the net cash price. So let's say monthly rental is 9,000 into 12 months. So in 12 installments, you need to pay this. So then we are getting the higher purchase price. Higher purchase price will be how much? Nine. Okay, monthly rental is 9,000. Tenor is 12 months. That I'll put it like that. Tenor is 12 months. Tenor or the period of the hire purchase is 12 months. Okay. So hire purchase price means this 9,000 multiplied by 12 months. Okay. So you get 9,000 into 12 months, we need to pay 108,000. 108,000. Okay. 108,000. Now this 10,000 already we paid. If we purchased on cash, we should have paid only 9,000, 90,000 more, but we are paying 108,000. So this difference, 108,000 minus 9,000, is the interest or return to the owner. Okay, owner means the hire purchase company. They get the return 18,000. That is because of the monthly installment arrangement that they have arranged. This is covered under Consumer Credit Act, and you can relate. If you buy a laptop on a easy payment scheme, if you buy a TV on a easy payment scheme, all these things come under hire purchase, right? So let's go back to PowerPoint. Yeah, these are the terms. I believe this PowerPoint, the tutorial will be shared by the institute with y'all so that you all can go through it again, or the recording will be made available so that You get it. So the net hire purchase will be the total hire purchase price minus the total count of delivery, installation, and insurance in the agreed and other charges. Don't worry too much on this. These are some definitions that I have given. Like the total hire purchase price is, now in that early example was 108,000 minus the total count of delivery, installation, and insurance in the agreed and other charges. So it's like I come back here. Let's say now this is the kind of the return, and this is the hire purchase price. No, total hire purchase price is this. Total hire purchase price is this. Now this is 18,000 I got, assuming there were no other costs. But if there are, let's say, installation, you need to take this fridge and transport it and hand over. And if there is an insurance involved, now for fridge and all, you don't normally go for insurance, but if there is anything involved, etc., I would say, let's say 5,000. So the net hire purchase price will be that 108,000 minus 5,000. 108,000 minus 5,000. 103,000. 103,000 net hire purchase price. So that's what it says. And don't worry about all these kind of things given here. Right? I've just given some definitions. Let me stop sharing this. Sorry, I have to share, not that one. I'm sharing the PowerPoint again. Hope y'all can see that. Okay. Yeah. So net hire purchase price is after deducting any cost like insurance and delivery and all this stuff. Net hire purchase charges, we talked about statutory charges, the cash price into rate stipulated by the minister into period. So if there is any statutory charges involved, you get it by the cash price on 100,000, whatever the rate, into the period. So it depends on, like, any charges imposed by the government, you'll have to pay if they are recent, right? Early payment rebate, it's like installment not due into D minus A over A into 2/3. Early payment rebate, cash price minus hire purchase price divided by cash price. So I'll work out that one for this particular example. Let me share the Excel sheet again. If there is any early settlement that the customer wants to make, early settlement rebate, you get it as, I'll use the formula that is given, installment not due. Installment not due into D minus A. I'll explain this D minus A. What is this? D minus A into 2/3, 2 divided by 3. The entire thing divided by A. A is the cash price. Now A means the cash price, which is equal to 100,000. Is equal to 100,000, and D equals hire purchase price. Hire purchase price is 108,000, not the net hire purchase price, because that net hire purchase price comes with installation and all, where owner will have to bear. it's not a problem with the hirer, the customer, right? So here, let's say if early settlement is done, if early settlement is done after 5 months, after 5 months, we want to make an early settlement and finish off this. Now it's like this, no? We have month number 1, month number 2, month number 3, up to 12 months. Up to 12 months, you have 9,000, 9,000 likewise. So this is your hire purchase payment schedule, right? So after 5 months, you want to settle. You want to go for an early settlement. Now that means installments not due means this part. From month number 6 to month number 12. Installments not due is 63,000. 7 months not due, no? Installments not due. 63,000 because 5 months already gone. 5 months already gone. Okay? 5 months gone. So here you get the early settlement rebate. Early settlement rebate will be installments not due 63,000 into D means the higher purchase price 108,000 minus cash price 100,000 yeah, into, and we have that 10,000 also, you know, we need to add that as well. Total higher purchase price, you need to add that 10,000 also. Sorry, it has to be 118,000. 108,000 is what we get, and there was a down payment that also has to come. Total higher purchase price. Total higher purchase price is okay, 118,000 here. 118,000 total higher purchase price. Again, a small issue with my Excel. I'll quickly work it out before we get stuck again. So early settlement rebate, here you get 118,000 minus 100,000 into 2/3, and here divided by entire thing divided by you can refer the video again and it down if you like. Okay, so here we get 63,000 into 8,000 into 2/3. By 2/3, if you want, you can write within brackets. 2/3 means 1/3 you need to pay. You can't give a full rebate for the entire thing. Divided by 100,000. Okay, you get like that. Divided by 100,000. Yes, you get 3,360 early settlement rebate. So out of the 63,000 that you need to pay, you can give a rebate of 3,360 kind of thing. That's what it says. But don't worry about these definitions much because company to company these things can change. We see that like we give a lot of early settlement rebates to encourage the early settlements by the leasing companies and finance companies. It's up to them. And it's just based on the formula. But for your exam purpose, if you get this, I just wanted you to work out this example and get an idea. If they want you to calculate it by any chance, you do that. This is the only calculation that you can get based on what we cover. But mostly it will be on the theory. So please note it down and let me know if there is any question about it. just check the mathematical accuracy. Like my Excel is giving me a bit of a problem. I don't know what the reason is. I believe the calculation. I just wanted you to get to know the method, right? Not the final answer, but it's the so you get the early settlement rebate, that 3,360 or whatever the answer that you get is the amount that the customer is getting benefited. There'll be a reduction. You know what is a rebate is, right? So we in leases also we sometimes give future interest rebate to encourage early settlements. And on the top of that, sometimes there could be early settlement fees to discourage the early settlements. But customer has a right to ask for an early settlement. On leasing, we have a right to, like the banks have a right to get the full future interest if they want, but on humanitarian grounds, they give rebates. But they have a right to ask for full future interest, but not on loans or not on higher purchases. Higher purchases like that. So there's some rebate entitlement. If you are okay with that, shall we move on, or you need more time to take down? Let me know once you're done. These are the data. Let me reduce the gap so that y'all can see the entire thing in the screen. So then now you can relate, like even some of these companies who were involved in these electrical equipment supply also now they have their own finance companies due to these obvious reasons of whether they can enter into higher purchase agreements they can, but if somebody argues this is just like a finance lease, just to be on the safe side, they have their finance companies as well. But earlier we saw that there was no such requirement. Hire purchase agreement can be entered into by anyone because it's governed by the Consumer Credit Act. So we saw banks, not exactly banks, but most finance companies and leasing companies, they had hire purchases also as a product. Are we okay with that? Do you have any questions up to that point? Okay, a final answer. Let me check because I'm also not sure. It's like installments not due 63,000 to 8,000 or 100,000 into 2/3. Let me double check that. Yeah, even I'm telling like just get to know about the procedure like uh, into 8,000 divided by 100,000 I'll get 5,040. So that into 2 divided by 3. No, this is okay. As per my calculation. Yes. Here 18,000. 18,000. I'm sorry. Yes, you're correct. Not 8,000. Not 8,000 here. It has to be 18,000. Yes, you are correct. Thank you so much. I put 8,000 there because earlier we had 8,000. We have to add that 10,000 also. That's down payment is also being paid by the customer. No? So that 9,000 to 12 months installment plus the down payment. So because at zero you pay another 10,000 here. That also you will be taking into account. So it will be 7,560. Correct. If they don't have a down payment, you can simply go with 108,000 in and 100,000. Shall we move on from there? Yes. Thank you so much for all the inputs that you are giving. We look at important points in HP contracts, hire purchase contracts. What are the important points? I hope you can see the screen. Prior to exercising a hire purchase agreement, the owner is required to inform the hirer in writing, offer in agreement of the price at which the goods may be purchased by them in cash, the cash price. In a hire purchase agreement, actually, it's the owner who communicates the customer in the agreement, or we have this letter of offer, or offer for the agreement of the price at which the goods may be purchased by them in cash. So the cash price they are mentioning, it's similar to the facility amount. It's just like the lease facility amount, but here we use the term cash price of the hire purchase will be communicated by the owner to the hirer, right? Hirer is the customer. Agreement should be signed by all parties to it, like the hirer, guarantors, and by the owner. Owner's representation and the witnesses have to sign. Hirer and the witnesses have to sign. If there are guarantors getting involved, guarantors also will have to sign. Agreement should state the hire purchase price, the facility amount, the hire purchase price. Cash price. Cash price is also mentioned here. That's very important, right? So the hire purchase price is the total amount payable, that 118,000. Cash price is the 100,000. If you are not going for a hire purchase facility, at what price you can buy the goods? Amount of each installment of the hire purchase price, like the 9,000 into 12 months, the amount of each installment, the deposit amount paid, 10,000, the down payment paid, and the list of goods. What are the goods? If it is a vehicle or an electrical equipment, or what are the items that are being bought? Because sometimes this is complicated because the goods are being bought by a business person, the customer. So it's complicated, but you need to mention all the entire list of goods, or even give it as an annexure in the hire purchase. We get this situation where products like trading muraba, like where it's involved in more buying and selling, and the bank or the finance company will provide the funds to purchase the goods. So the list of goods will have to be mentioned in the agreement. More importantly, a copy of hire purchase agreement should be sent to the hirer within 14 days of the date of agreement. Usually we do that, like we immediately send the agreement. It should be sent. But there were instances where like not finance companies and banks, when other companies enter into the agreement, the hire purchase copy of the agreement are not given to the hirer. That is bad. Like always, we have to ensure that a copy of the agreement must be given to the customer as well. If any of the above set conditions are not complied with, the hire purchase agreement is not valid by law, and any security for the agreement, including guarantees, bank or personal guarantees, are also not pre-enforceable, not enforceable. If any of these things, like, let me remind you again, cash price to be mentioned in advance as an offer letter, offer agreement to the customer. Agreement should be signed by both parties and the guarantors. Agreement should state the hire purchase price, the cash price, and installment value, the deposit amount, the down payment paid, and the list of goods involved. And more importantly, a copy of HP agreement should be sent to the hirer. Copy of the agreement must be given to the customer in 14 days. If those are not, if any of the conditions are violated, then there's a problem, like the hire purchase agreement is not valid and somebody goes to courts, there'll be a problem. You can't enforce on the payments, or you can't enforce on the goods. The goods ownership may be retained by the hirer. Ownership can be retained by the hirer, but in vehicles we have still seen absolute ownership comes to the company. It's like more like a lease then, but usually ownership will be now. The hire purchase finance lease is more favorable in terms of the bank or finance company. Hire purchase is more favorable in terms of the customer. So customer can retain the goods. Unlike financial lease, all HP agreements, the owner guarantees the quality of the goods. Now it's the bank or the finance company, they have to agree the quality of the goods. If it is the electrical equipment seller, no problem, they will guarantee their own goods. But how can a bank or a finance company guarantee? If there's a problem with the goods, there'll be an issue. That is why we get the delivery order, the purchase order, the delivery order signed by the customer, confirming that they have received the goods in order. That's why the delivery order has come to the leasing agreements as well. The reason behind is this: the customer confirmed that all the goods have been received in good condition and order. So therefore, the hire purchase company doesn't have to worry after that. Only second hand, where the hirer examined before entering into the hire purchase. So if it is some goods in the second hand, like if it is like in, say for an example, if it is not now, if the electrical company providing their own goods, they are still liable. But if it is a bank providing finances for the customer to get the goods from another person, and beforehand, if the bank has gone, somebody from the bank has gone and examined the goods, it could be a vehicle, it could be any other goods, and after that the agreement is entered into, then bank can't guarantee practically, like, that is why we use the delivery order to make sure that the customer communicates us that they have received the goods in order, and thereafter we are not liable, because practically we can't, as a finance company, to go there and ensure the goods after we make the inspection. That is why the vehicle inspection or the goods inspection is also very important. We sign that document, the inspection officer, make sure that, with all the features and everything, it's entered and it's signed and it's attached to with the security documents to confirm that they have inspected before entering into the agreement. All these things are to safeguard the finance company and the bank. Therefore, to avoid liability, the owner always ensures that the hirer first examines the goods and confirms in writing to the owner. So hirer, the customer has to first examine the goods and confirm in writing. That's where the delivery note is used. In HP agreement, the hirer may terminate the hire at any time before the end of the term by returning the goods to owner. I'll compare this with the leasing as well. Now, if it is a lease agreement, usually it's lessor who terminates. But if the lessee also wants, can terminate, but have to hand over the goods, hand over the vehicle, has to hand over the vehicle to the bank or the finance company that can terminate with a proper notice. That could be done. In hire purchase agreement, hirer can terminate, that the customer can terminate the hire at any time before the end of the term by returning the goods to the owner. You can hand over the goods and terminate it in hire purchase. However, if hirer terminates before the end of the hire purchase terms, the owner is entitled to recover half of the purchase price from the hirer, including all installments paid up to that point and the deposit. Okay, if I go back to my Excel sheet. Okay, let's say if a customer wants to early settle this, now this is an early settlement, no? Customer wants to early settle, like let's say after 5 months the customer comes and hands over the fridge back to the supplier and says, I don't want it, I don't want to continue with the hire purchase. Now at that point we look at how much is paid. Now we have paid 10,000 plus 9,000 into 5. 9,000 into 5. 9,000 into 5. We have covered 55,000. That is more than 50% of cash price. More than 50% of cash price. Okay. More than 50% of cash price. Yes. Half of the purchase price. Okay. So if that is the case, no problem. But if it was less than 50,000 by any chance, the owner, the bank has a right to ask that if let's say if the customer terminates after 2 months, the bank can say, no, you need to pay up to 50,000. But if it is more than 50,000, that's it. That's how it goes. But in practice in Sri Lanka, they don't go by this 50%, they go by 75%. If it is more than 75%, the owner can't go and repossess the asset if more than 75% of the capital is paid. But as per the Consumer Credit Act, it says basically you cover 50%. Up to 50%, the customer will have to pay even if he or she wants to terminate before that period. But if they have made more than 50%, including the down payments and everything, then hire can terminate at any point. If the total investment paid, installment paid by the hirer together with the deposit is equal to half of the purchase price, hirer may return the goods without making any further payment. That's in my example. Now at that point, 55,000 altogether paid. No? So hirer can hand over the fridge without making any further payment. That's the advantage from the consumer's point of view. If the total payment including deposit exceeds half the purchase price, he is not entitled to any refund. So 55,000, so he can't go back and ask, okay, I have paid 55,000, you want minimum 50,000, give me back the 5,000. No, it won't be refunded, but you don't have to pay an extra payment. In either case, all arrears must be paid by the hirer. If there is any arrears, it has to be paid by the customer, because if he has defaulted for 2 or 3 months and going on handing over, the default renters have to be settled. Any termination of the hire must be preceded by 14 days of notice in writing. For hiring, it's 14 days, but under leasing now it's 7 days is also possible, depending on the Finance Lease Act concerns and the agreement that we are entering into. In hire purchase, it's the 14 days of notice before termination. Due to the fact that the hirer is entitled to terminate the hire by returning the goods, hire purchase agreement should only be entered into in respect of goods which have an estimated secondary market and the value which is stable. So if a company is entering into a hire purchase agreement, again, you have to be very careful. It's just like in operating lease. So there must be a second-hand market. If not, what happens if the hirer terminates in advance, like, and hands over the goods, you'll be in trouble if you can't sell it to another person. So we'll have to make sure that second-hand market is available. Finally, to summarize, these are some of the pros and comparisons between the Finance Lease Act, the Finance Lease, and the hire purchase, the Consumer Credit Act. You can just see. In the Finance Lease, absolute ownership is the lessor and the registered owner is lessee. Right, let me make it full screen. Absolute owner is lessor and registered owner is lessee, whereas in hire purchase, absolute and registered ownership lies with the owner. Owner means the bank or the finance company or the hire purchase company. Absolute and registered ownership lies with hire purchase company. Lessor can repossess leased item at any time if rentals is defaulted after termination procedure. Even if it is just one rental outstanding, if the lessor wants, can go and like let's say the lease period is for 48 months, 47 months paid by the customer, 1 month not paid. If the lessor wants, can go and terminate it and repossess the vehicle or the asset. But in hire purchase, after 75% of the hire purchase has been paid by the hirer, repossession cannot be done. So you get an advantage for the customer there, like 100,000 the cash price. If the more than 75,000 of the capital is paid, owner, or what do you call, even though you are an owner, you can't go and repossess the asset. You can't, the hire purchase company can't go and repossess the asset. Act provides repossession of seizure through courts if resistance is offered. Under Leasing Act, if the customer resists for repossession, based on the Finance Lease Act, you can get the court order, or you can inform the police and even they seize the assets. But the Consumer Credit Act does not provide seizure through courts. Court order repossession is not possible under Consumer Credit Act. So Consumer Credit Act is more favorable for the customer. Notice of substantial failure for 7 days. Notice of termination 7 days. Finance Lease Act. Notice of termination 14 days. 7 days if hire is payable weekly. If the hire purchase is a weekly payment one, 7 days. If it is a monthly payment one or more than 1 week, 14 days of notice. Whereas in lease, 7 days of notice. Lease rentals does not have to indicate capital and interest. In the lease rental, you can just mention 100,000 is the lease rental. You don't have to mention the capital and interest, even though in the rental schedule we have the capital and interest. But Consumer Credit, cash purchase price and the hire purchase price should be clearly set out. Like there we disclose only the lease facility amount and the rental. Here, cash purchase price and hire purchase price both should be clearly mentioned. Leasing, lessor should be registered under Finance Lease Act. Consumer Credit Act, no registration is required. So for you to grant a finance lease facility, you have to be registered under Finance Lease Act, and you have to be authorized in by central bank as well. But hire purchase, any company can enter into, no registration required. Lessee can recognize assets in the book and can claim capital allowances. For lessee, there's an advantage. If you get a lease, the lease rental is a deductible expense for tax purpose, capital allowances, right? For hirer can claim the interest portion as a tax deductible expense. So lessee, in lease, you get the capital and interest both inside the rental. Since it's not disclosed, the entire lease rental can be deducted for your tax purpose. Like you can deduct that and reduce your tax liability. But in terms of hire purchase, we say how much is capital and interest. The hire purchase interest is a deductible expense for tax purpose. Termination is straightforward in lease. Termination as per statute in Consumer Credit Act. You have to follow the Consumer Credit Act rules and regulations and do the termination. And fraudulent sale or transfer of the goods amount to substantial failure on the part of the lessee. If there is like, if the lessee sells the goods or transfers the goods without the knowledge of the bank to another party, it's a fraud. Like it falls to substantial failure, and the bank or the finance company can go and immediately acquire the asset. But Consumer Credit, the hirer shall be guilty of a criminal offense liable to a fine, imprisonment, or both. If hirer does it, like it could be a criminal offense, you have to file a case as a criminal offense and then go for legal action. So those are the basic differences or like comparison between the finance lease and hire purchase based on the provisions of Finance Lease Act and the Consumer Credit Act. So with that, I'm coming to the end of my presentation, but still, if you all have anything to clarify, if you all want to clear any doubts, it's open for you. You can ask any question. So as I told you, like the 4 hours allocated, but I usually don't want 4 hours for this session. But today I went on explaining a little bit with more examples and Excel calculations and all, so that you clearly understand it. Still, if there is something that is not clear or you want to ask anything, floor is yours. You can ask. Were you clear with all what I said or not clear at all? If there is any question, please go ahead. I'm more than happy to support you. Thank you for all those who are interactive and asking questions and giving your feedback. Thank you so much. If there is anything further, I know that like if you are working, if you're attached to a bank or if you're attached to a finance company already, you may be familiar with most of these, but still there can be questions. Of course, in practice, we encounter a lot of like now this is the theory, like this is the provisions from the acts and the provisions from the legal point of view. The session that I planned to cover today was all that. I believe through the Banking Institute, you should be able to get the tutorial, the PowerPoint slides that I shared, and like even if necessary, I'll share that Excel sheet as well. But I believe you all have taken down whatever required. And since it's a recorded session, I believe you all can go through the recording again if there is anything. But still, if you want to clarify something on what we covered, basically we covered about the finance leases, operating leases, and hire purchases. And we identified some similarities and differences between a finance lease facility and a hire purchase facility, giving in line to the legislation, the law, Consumer Credit Act and the Finance Lease Act. So what are the differences we looked at? Anything you were not clear, you can ask. If not, we can wind up for the day. So I will get the institute to share the PowerPoint with you and or in the tutorial format, and they'll be having the recording anyway. If anyone who could not join, that's what we told. So apologies on the change of the time due to my unavailability on Sunday afternoons. So we had to change the time. And thank you so much everyone who joined in. Thanks Nilushi, all clear. Thank you for today's session. So I'm glad that all what I mentioned was clear to you. So if there is any issue, please feel free to contact me through the institute and get it clarified. Mostly focus on the theory what I shared, except for there maybe if it is a calculation, it may be about that early settlement rebate that comes in. Don't worry about IRR, XIRR and all. I just showed it for your understanding purpose. That's all. It will not come as a question from this area, the computation, except for the early settlement rebate, sometimes can be tested. But apart from that, because those things are changing time to time with the current industry requirements, you don't stick to 2/3 rebate or anything else of such. Those things can change, but this is what the Consumer Credit Act says. A lot of finance companies and banks have customized all these options without violating the Consumer Credit Act or the Finance Lease Act, as the case may be. So they can, I mean, within the legal framework, they can have customized solutions for their customers to keep them happy and to attract more businesses. So they do that. So that's how we go on. Then I wish you all the best for your exams. And if there is anything, just be in touch with me through the institute. Like, and please get yourself clarified on any doubts that you have, even in the future. Thank you so much for being such an enthusiastic and an interactive audience today.